Downstream and Sub-Tier. Okay, the first two reports were about the primes, Lockheed, RTX, Northrop and the European names. We established the backlogs are real. Everybody already knows the backlogs are real, and the market already priced the backlogs. Nothing wrong with that work, but it isn't where the edge is. In this report, we'll go downstream. Look at the layer beneath the primes, the sub-tier suppliers who actually make the rocket motors, the seekers, the magnets that go into everything else. So we're looking at a map, not a shopping list. The argument can be said in one sentence, which we'll get to. Reports 1 and 2 concluded that the binding constraint on munitions restocking isn't money, it's physics. Solid rocket motors, energetics, rare earth magnets. You can appropriate all the budget one likes, but you still can't create a rocket motor factory into existence in 18 months. Now, if that's true, and Fryer thinks it is, the evidence is quite strong that it is, then the operating leverage doesn't sit with the primes, it sits one layer down. The suppliers who've been starved of capital and orders for 2 decades and are now, for the first time since the Cold War, looking at genuine sustained demand cycle. The number on this slide we need to focus on is the THAAD-1. So a $35 billion award moves Lockheed's backlog, which is already $230 billion, by about 15%. That's not overly exciting for a portfolio manager. However, that same award, aimed at a sub-tier supplier, can double their entire order book overnight. That asymmetry is the whole report in a sentence. Okay, the structural fact and why it can't be fixed quickly. Let's start with rocket motors. Here's the structural fact. Between 2000 and 2015, the US solid rocket motor industry went from 6 suppliers down to 2. Aerojet Rocketdyne, which is now part of L3 Harris, and Orbital ATK, which is now part of Northrop. The Centre for Strategic and International Studies, CSIS, calls this the single most consequential constraint in the entire US missile defence industrial base. Plus, US Army's own Undersecretary for Acquisition put this in writing in a 2025 submission. So when the buyer of last resort is telling you in an official document that the bottleneck is real, best we sit up and take notice. Why can't we fix this with money? Because both of the 2 remaining suppliers are themselves dependent on a handful of shared component suppliers for the gases, igniters, the nozzles. The L3 Harris CEO said it plainly, and in some cases, they've only got 1 or 2 certified suppliers for these parts. The bit that's really brought this home for Fryer is the accurate energetic systems. They supplied energetics to Aerojet, Northrop and Nammo all at once. But in October 2025, they had a fatal plant explosion. That's concentration risk stopping, being an abstraction on a slide and becoming a real story about how thin this industry has actually become. Layer 1. Okay, so we accept the structural fact. So the next question is, who's actually in this sub-tier? There are categories like energetics providers like Chemring, nozzle manufacturers like Fiber Materials, guidance component manufacturers like Moog. What they have in common is they're all sub 5 billion market cap, plus 70 to 80% is US revenue, defence revenue exposure. And there's very little sell-side coverage. There's not many punters writing equity notes on these names. For those in the UK and Europe, Chemring, being on the London Stock Exchange, you'd be aware of. There's a wave of new entrants trying to break into the space. We mentioned earlier, but most of them are private. The CSIS makes the point that many of these new firms haven't yet made the jump from prototype to genuine production lot manufacturing, and that's the hard bit. We can flag Cambridge Aerospace, who raised a very impressive 300 million Series C to build what would be Europe's first SRM, short-range missile factories. But as of the middle of this year, it's still under construction, with no production confirmed. Thus, promising is not the same as proven. Then we can talk about public money. $1 billion from the Pentagon into L3 Harris capacity. Another 1.3 billion L3 Harris own money into their Virginia expansion. Camden in Arkansas, designated to the Centre of Excellence. It's all useful, but CSIS's own verdict is worth repeating. This kind of direct-to-supplier intervention cannot substitute for genuinely proactive supply chain management across the whole sector. So money is necessary, but it's not sufficient. Layer 2, one building can gate a $50 billion program. Here's an interesting point. Patriot, the PAC-3 MSE interceptor, has an active radar seeker, and that seeker is made by Boeing in a single facility in Huntsville, Alabama. One building. Roughly 650 to 700 of these were delivered in the whole of 2025. Think about the scale mismatch. This is a $50 billion plus interceptor program, and its output is gated at whatever one factory in Alabama can physically produce in a year. The Pentagon signed a framework in April 2026 to triple that seeker production, which tells us two things at once. They know it's a bottleneck, and tripling a single facility's output is not something that happens overnight. Importantly, this slide generalizes well beyond Patriot. Wherever we see a single facility, single certified supply choke point, as in seekers, nozzles, cases, igniters, precision castings, forging, we're looking at the same pattern. It's the kind of thing that doesn't show up clearly in discounted cash flow models, but it absolutely shows up in delivery schedules. That's the point. Layer 3, China's grip and the timeline that follows it. Rare earths, back to rare earths. China, 60% of global mining, over 90% of refining, over 90% of magnet manufacturing. And what makes this different from an ordinary commodity story is the extraterritorial reach of the controls. As we talked about in Report 2, China is restricting magnets made using Chinese process technology even outside China, down to a threshold of just 0.1% Chinese origin content. That's an extraordinarily low bar, and it's designed to hurt. Now the timeline. Because this is where it becomes tradable information rather than just background noise. We talked about this as well yesterday. From December the 1st, 2025, foreign military-affiliated firms are largely being denied export licenses. There's a full ban on Chinese origin rare earths in US defense applications due to take effect in 2027. And importantly, a second wave of Chinese export controls has been suspended, but only until November 10th, 2026. Okay, so again, as I mentioned before, that is a date. It's a binary event. Yes or no. We need to mark that down. Layer 7. Western supply chain names and evaluation warning. So who's building the Western alternatives? 3 names have come up again and again, not as tips, but just as a map. MP Materials operates Mountain Pass in California, the only active US rare earth mining and processing site. And remember, the Department of Defense took a $400 million equity stake in them in 2025. Lynas Rare Earth in Australian. They're in Mount Weld, processed via Kalgoorlie in Malaysia, and they're currently the only company delivering separated heavy rare earths at commercial rates to non-Chinese customers. And remembering they got $120 million to build out the first commercial heavy rare earth separation facility on the US soil, but it's several years from production. Then there's US Rare Earth. It's the smallest and roughest of these 3, a magnetic plant in Stillwater, Oklahoma. Still early days there. And some valuation warnings. MP's share price already reflects a lot of bullish consensus about supply chain reshoring. Lynas trades on a premium price to sales multiple, and its extraordinary 1-year return is best understood as scarcity premium rather than pure fundamentals. And both rely on external funding, and both have volatile earnings. Layer 4, tungsten, and the second order downstream. Tungsten sits at a genuinely interesting intersection. It's needed on the demand side for penetrators and kinetic energy rounds, but also on the supply side because it's the tooling material used to machine practically everything else in this sector. China supplies about 1/3 of the EU's tungsten and about 80% of the world production. This is the same physical shortage logic we've been running through the whole series, just one layer further down, and it links directly to Fry's Hormuz commodity cascade work we've been talking about earlier this year. Now, Almonty Industries is the listed pure play most often cited in the trade press. So why are we talking about the sub-tier, not the primes? Well, this is the table. Have a look at it. It's the crux of the whole report. On order visibility, the primes win easily. Record backlogs, excellent transparency. The sub-tier's order book follows with a lag and is much harder to see clearly. On re-rating, the primes have largely already moved. Northrop actually fell on a double beat, which tells us the good news is definitely already in the price, and Rheinmetall is up over 500% in 3 years. The sub-tier is much more mixed, and a lot of it is thinly covered enough that re-rating simply hasn't happened yet, whether that be for better or worse. The leverage row is the one that matters most to us as options traders. One award is marginal to a prime, as we mentioned, 15% on a $30 billion book The same award can be transformational to a sub-tier name, but look at the rows underneath. Diversification, liquidity, execution risk. The primes are diversified, liquid, with moderate risk. Sub-tier is usually undiversified, often illiquid, and definitely high risk, because, and this is quite plain, these are the exact firms that have been failing to deliver for 2 decades. That's not a throwaway line. That's the whole reason the constraint exists in the first place. So the trade-off is an honest one. And Fry thinks it's worth thinking about. The sentence at the bottom of the slide: buying the bottleneck is buying the thing that has historically not worked. However, that doesn't mean don't look. It means look with our eyes open. Finally, a watch list. And this is not necessarily about specific tickers. This is just items, things we should be watching for to give us some sort of direction, something to add to the chain. The China second control wave, suspended until the 10th of November, that's the one genuinely dated binary catalyst in the whole report. So we'll put a note on that. Fryer will keep an eye on it. Interceptor delivery rates against the 2,100 unit calendar year 2027 target are realistically the only honest scoreboard for whether any of this reshoring is actually working, as opposed to just being announced, which is quite likely in Fry's opinion. And the Boeing PAC-3 seeker output against that tripling framework is the cleanest single choke point to track, precisely because it's one building and one number. The rest, the MP Materials run rate, Linus ramp, Cambridge Aerospace's first production, new entrants moving from prototype to production lots. These are all much slower moving, rolling indicators. They're not the kind of thing we'll check daily. They're the kind of thing we'll check quarterly as part of keeping the fundamentals picture current. Finally, many of these names are small, illiquid, lightly covered, risky, very risky. A sub $5 billion market cap with 70 to 80% revenue concentration to a single customer does not behave like a prime, full stop. Government-dependent revenue is a double-edged sword. Undefinitized contracts, appropriations risk, program cancellation. As we mentioned, Rheinmetall's F126 program losing a $300 million contract is real. Recent example of exactly this cutting the wrong way. Just to finish off, these three reports were more geopolitical thoughts, not really for trading. I think that was pretty obvious to people. I'm genuinely concerned. I'll leave it there.